Hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have you all with us today as we talk about capital budgeting and investing. These are both very important concepts for business because this is how businesses utilize funds to invest in property, plant, and equipment, and also how companies utilize funds for other investing strategies like buying stocks and bonds and uh, investing in things like land that we hold available for sale, or we don't sell it and we hold on to it and then sell it later on. Those are the types of investments that companies typically do. So we'll talk about both the concept of budgeting for property, plant, and equipment, and we'll also talk about how companies invest for the future. So before I jump into today's discussion on budgeting and capital investment for budgeting and investment, I want to quickly call your attention to the classroom. So as you know, we are in the last week of this course. Yay! I think. Yay! Right? Kind of yay. Okay, I'm sure you're somewhat excited because, yeah, we made it all the way to the end. Uh, so interesting thing to note that this course actually ends on this Saturday, right? So that whatever day that is, I think it's the 13th, if I'm not mistaken. Yeah, 13th. So it ends on Saturday, not on Sunday, but on Saturday. That's just how the university does their summer routine, right? It's because the next semester's starting soon. Um, so this course ends on this Saturday. Now, what does that mean for you? So we're in the last week. Most of you have already worked ahead, even, and done the Chapter 26 quiz. Good for you if you did. If you didn't, that's fine, but just make sure that you complete it by Saturday. In addition to the Chapter 26 quiz, you also need to complete the final exam by Saturday night. Again, Saturday night, not Sunday night, Saturday night. So I just wanted to call your attention to that very, very important piece of information to make sure that both of those are done by Saturday night. Uh, Chapter 26 is kind of difficult, as you'll find out, and it's because we're talking about different kinds of strategies that we haven't really talked about before. Because this is the end of Principles of Accounting, we're really talking about how finance and accounting are kind of interconnected. Finance is a completely different subject than accounting is, but it's important to understand how the two are related. And so that's really what Chapter 26 talks about, which is why it's difficult for some students to understand. And we'll talk all about that. And so when we're done talking about property, plant, and equipment, budgeting, and investing strategies for the company, after we're done talking about all those things, we'll also talk about the final exam. So it's good that you're here because we'll talk about the final exam. I'll show you what it looks like. We'll talk about the questions and where you can find the questions from your previous chapters. So I will take care of you, I promise. So, okay, let's jump into today's discussion on budgeting for property, plant, and equipment, and we'll also talk about investing strategies for the company. And from that perspective, we'll talk about investing strategies using things like the payback period, internal rate of return, accounting rate of return, and net present value. These are all finance concepts, but it's important to understand those in accounting because the company needs to account for when these are used. Right? That's why accounting and finance are relatively related. So first, let's talk about capital budgeting. Capital budgeting is a budgeting process where the company sets aside capital for long-term investing to acquire or sell property, plant, and equipment. Though, as you know, property, plant, and equipment are also known as fixed assets or long-term assets. Property, plant, and equipment. These are fixed assets that involve budgeting because they are long-term investments. In addition to property, plant, and equipment, some companies might also purchase other assets that are held for the purpose of investing. And what I mean by that is sometimes companies will purchase a piece of land and never develop the land. They won't do anything to it. They'll just purchase land. Okay? And the reason why companies will sometimes purchase land as an investment is they understand that land never depreciates in value. The land never goes down in value. That's why, for those of you who are in the housing market or are soon to be in the housing market, or maybe you already are, you notice that the value of your land is increasing. It's not the building, it's the land that's valuable. Okay? What I mean by that is you'll see that your tax assessment for your property always goes up. Like it'll never go down. I mean, it just doesn't happen. Okay. The reason why that is because land, as you know, in certain areas are at a premium. It's difficult to get land. For example, in DC, it is near impossible to find an empty lot pretty much anywhere, right? You know that you've driven around the city, you've hopped on metro around the city, and you know there's no empty lots. You know, we're tearing down buildings to put new ones up, right? And, you know, that's the nature of DC. You know, where land is at an absolute premium in DC. You can't find vacant property, and when you do, there's usually a structure already there. You have to knock it down to build a new structure. So, because land is at a premium and the value does nothing but go up, companies understand that, and they will sometimes purchase vacant land and hold on to it, right, as an investment. Very, very common. That's why sometimes in the news you'll see that people's rent goes up a lot, right? And especially over the past year, like in certain cities, including DC, people saw their rent increase over the course of 1 to 2 years, like 20%. That's huge. Why does that happen? Because the company that owns the land sees the premium value rising. So they make market adjustments. A lot of companies owned a lot of land, and they'll hang on to that land to later sell it as an investment. Right? That's the whole idea behind this. So land can be held as an investment. Companies will also make long-term investments in other companies. Now, the way that they do that is they will purchase large amounts of shares of stock in other companies to hold them as an investment, as a long-term investment. Now, the reason why companies might invest in other companies is to gain on the value of the shares of that company over time, or there might be a possible acquisition where the one company might purchase, we'll say 51% of another company to then acquire that company, right? So in other words, one company is buying another. So a lot of that stuff happens. And we use capital budgeting in our companies to understand the future acquisitions or sale of long-term investments. So the process. First, the department or plant manager would submit a proposal, which is to acquire or sell property, plant, and equipment. Then the budget committee, which usually involves the CFO, the controller, and usually a couple lead accountants, and the various managers will evaluate those proposals to purchase or sell property, plant, and equipment. And in that evaluation process, what happens is the committee gets together and they'll evaluate different options, right? Different proposals. And they will rank those proposals using financial formulas that we're going to talk about. And they'll evaluate their based on things like useful life, how long it lasts for, depreciation expense over time. And they'll also look at things like its potential use, like its output. And the committee will evaluate different proposals based on those criteria. And the third thing that happens in the capital budgeting process is the board of directors at the company will then approve or deny the proposed capital expenses, which involve setting aside funding for the purchase of that property, plant, and equipment, or sometimes the sale. But that's the typical process that companies go through. As you would expect, with any investment decision, there is risk. Okay, this is the same for both individuals and companies. There is risk involved in the purchase or sale of property, plant, and equipment, and there's also risk involved in stocks, bonds, or any other investment decision. And because of those risks involved in investing, it's important that the company takes risk into consideration when making a decision on which proposal to purchase property, plant, and equipment to go for, right? So risk is so important to take into consideration because of those reasons. So one of the reasons is the outcome is uncertain. Well, of course it is, right? If I purchase a share of stock in Starbucks today, I don't know what's going to happen when I sell it, right? It might go up, it might go way down. I might lose the whole investment, right? So the outcome's uncertain from a personal perspective. From a business perspective, let's say I purchase a new piece of machinery to maximize my output, to increase my output. I can make more of this type of product if I purchase a specific machine. But that outcome's uncertain. Why? Because what happens if demand all of a sudden plummets for my product? Now nobody wants it. Now I'm stuck with this brand new piece of machinery. So the outcome is uncertain. The second one is there are large amounts of money involved. Okay, I got to have a lot of cash on hand to purchase a new piece of machinery or put up a new building or whatever. Usually, we're talking millions of dollars, right? So, why is that a risk, you might ask? It's a risk because I'm throwing millions of dollars at purchasing this piece of machinery, and something could happen, right? All of a sudden, I don't need that piece of machinery, but I already got it. Well, then I got to try to sell it, right? So then what's happening is you're putting yourself in a cash-strapped position. What I mean by that is if you tie up too much of your cash, you won't be able to make other investment decisions, right? Because now you're committed with a large sums of money. So that's a risk. Another risk is, as I had said, because they're kind of related, right? investment involves a long-term commitment. So like if I buy this piece of machinery, I know I'm going to have to be stuck with this piece of machinery for a real long time because its useful life is 10 years. I need it to produce a certain amount of output in order for it to make sense. So I got to run a break-even analysis. Um, it involves a long-term commitment. So, and I'm going to have to keep paying for the maintenance of this machine, etc. Right? And the fourth risk is I can't reverse the decision once it's made. It's so difficult or impossible to reverse the decision once it's made. I can't just say, oh, I'm so sorry, machine vendor. I didn't mean to buy this. You can't return it. There's no returns on a piece of machinery. There's no returns on a building. You make the decision. You can't return a building. You can't return millions of dollars in the machinery. It's no, it don't work that way. So one of the risks is once you've made the decision, it's very difficult to go back on it. Okay. So those are the four primary risks involved with capital budgeting and making a decision to purchase or sell property, plant, and equipment. So it's important that as we're looking at proposals for the purchase or sale of property, plant, and equipment, that we consider the cash flow. Yeah, it's all about cash, right? The only reason why a company would purchase a new piece of machinery is to increase their output, right? That's the whole idea. And in that endeavor, I need to consider the cash that's involved because I know that the machine will eventually make more cash for me because it'll help me to produce more and I'll be able to sell more. But initially, it's going to cost me a lot of cash up front, right? But let's take this example into consideration. I need to buy a new piece of machinery to help me to produce um, more of my product that I sell. More, let's say I'm Texas Instruments and I manufacture calculators, okay? I'm Texas Instruments, I manufacture calculators. And I need to purchase a new piece of machinery to help me to make more of my BA2 Plus calculator, which is the best selling calculator on the market. And I know that that will help me to generate more revenue from sales of that calculator, right? So the machine cost me $10 million up front, okay? $10 million piece of machinery. That's a lot of money, right? So I need to consider the initial cash outflow of the $10 million. So at year zero, it's year zero because I haven't started operating that machine yet. At year zero, I have an acquisition cost of purchasing the machine of $10 million. So I have initial cash outflow at year zero of $10 million. So that's step one, figure out the initial cash outflow. Step two is to figure out the use, which is how much I will be using the machine to generate additional cash inflow from my revenue. Remember, revenue comes from sales, right? So if I bought a $10 million piece of machinery to manufacture more of the BA2 Plus calculators, I need to figure out the cash inflow from the sale, the revenue generated from selling these calculators that came off of the piece of machinery that I purchased. That's cash inflow, cash coming in from my customers from the sale revenue of the BA2 calculators that I made from the same piece of machinery that I purchased. I mean, of course, there's some cash outflow, right, from expenses, but we look at what's called net cash flow for multiple years. And I look at it over the life of the machine typically, and at what point do I break even? In other words, what point do I recover the initial cost of the machine? That's what we call the payback period. We'll talk about that here in a second. And then the last thing I need to figure out is the disposal. At the end of the useful life of that $10 million piece of machinery, what's the salvage value? What can I get for it after it's done? You know, like, hey, it's cost me $10 million. It'll last 10 years. At the end of that 10 years, how much can I get for it? Because we know it's depreciated in value over that 10 years down to pretty much zero. But it's probably still worth something. Scrap value, right? Salvage value. So it's probably worth the scrap metal or the parts or whatever. So what's the cash inflow I get from the disposal at the end of its useful life? Or maybe before its useful life if I don't have a use for it anymore. So those are the things we think about when we evaluate a proposal. So I had mentioned that at a certain point in time, we're going to cover that initial cash outflow, the original cost of the machine, the acquisition cost. If it cost me $10 million and it has a useful life of 10 years, at what point within that 10 years will I have recovered that $10 million from the sales that I've generated using that machine? That's the payback period. And there's a way to compute that, and I'm going to show you what that looks like. So again, the payback period is how long does it take me to recover the initial investment amount? Initial investment amount is $10 million for that piece of machinery. Okay? It lasts for 10 years, the machine will. I expect to generate revenue every year from the sale of my calculators that were produced using that piece of machinery. So at what point in time will I recover my $10 million? This is the formula that I use. I take the cost of the investment, $10 million, divided by my annual net cash flow. Let me break that part down for you, okay? Net cash flow is the operative word here. Net cash flow. It's the cash that comes in minus the cash that goes out equals net cash flow. Okay, net. The cash that came in from my sales minus the cash that went out, paid my bills, my operating expenses, equals net cash flow. So cash coming in from my sales, my revenue, minus my cash that went out, my operating expenses, equals my net cash flow. Annual net cash flow is the net cash flow for each year, right? Annual. So that's annual net cash flow. We know that typically annual net cash flow is not the same every year. My sales go up and down every year, okay? So I know that they're not going to be the same every year. In some businesses, they are the same every year, the net cash flow is. And those businesses typically only have one customer, and it's usually on a contract, and it's the same amount of cash every year. So it does exist, but in most cases, it goes up and down. Depends on the kind of business, right? Or the type of project. Now, obviously enough, I would want a very short payback period. The shorter the payback period, the better. What I mean by that is, if I can recover the initial investment cost in a short amount of time, there's a great chance I would approve that proposal for the purchase of that equipment. Now let me show you another example. Earlier I had said that some companies have even cash flows. What I mean by that is they have the same net cash flow every single year. And that's because they only have one customer, or they have a contract, or whatever their situation is. But it's the same cash flow every single year. Same amount of cash coming in, same amount of cash going out, equals the same net cash flow. So I'm going to give you an example using even cash flows, which simply means the same net cash flow every year. And I'll also show you an example where it's uneven cash flows. So here's the example. Our company, Fast Track, remember them? That company, they make that part for, it's like a starter part, right, for the car? We've talked about that before. So they're looking at buying a new piece of machinery. The initial cost is $16,000. Okay, not bad. We have an estimated useful life of 8 years. Its salvage value is 0. Okay, so we're not going to get anything at the end of its useful life. It's going to be worth nothing. We have an expected production of 30,000 units. Okay, not bad. And we have a sales price of $30 per unit. So we need to calculate the payback period. So remember, the formula for the payback period is the cost of the investment, $16,000, divided by the annual net cash flow. Now here's how you figure that out, the annual net cash flow. It says, and I'm going to use my calculator for this one. It says that we are going to sell 30,000 units. Okay, that's how many we're going to make using this piece of machinery. If I have a sales price of $30, so 30,000 times $30 gets me $900,000 of cash flow. It's not per year. That'd be awesome if it was, but it's not. So we take that $900,000 and we divide that by 8 years. Okay. Let me show you what that looks like. I'm sorry, payment. The annual net cash flow. Obviously, I went a little too high in that one. What it didn't give us is the outflow. It did not give us the cost, the annual cost. Because remember, the inflow is from the sales. The outflow is from the expense, the operating expenses. So our net cash flow is $4,100 a year. So we take the cost of the investment, $16,000, divided by 4,100 net cash flow, and their expenses must be huge, gives us 3.9 years. What the 3.9 years represents is the amount of time it will take us to recover the initial investment of $16,000. Make sense? You all good, right? Still awake?
Yes, Professor, thank you.
Awesome. Thank you, Celine. Okay, very good. So now that you understand what it looks like from a even cash flow perspective, let's talk about uneven. Even simply means that it's the same every single year, as you know. Uneven is when our sales go up and down every year. Okay, so do our expenses. Which is typical. This is very typical for any business. Our sales and our expenses go up and down, usually with demand. So let's take a look here. Uneven cash flows. This means our annual net cash flow is going to be different, typically each year. Sometimes it'll be the same, but most times it's different. So let's look at our example here. The machine costs $16,000, has 8 years useful life, seller's value is 0. Let's look at the annual net cash flow for uneven. So when it's uneven, we do what's called cumulative totals. Cumulative totals is simply taking the initial cost, the $16,000, and we add in the net cash flows for each year. There's a formula for it. It's complex. It's called the present value payback period. Okay, it's a model. We're not going to dive too deep into it because it gets very complex. But I just want to show you this part from a visual perspective of how it works. So year 0, we have minus 16,000. Why? Because we're not making anything at year 0. We're just getting started. Okay, we're just setting up. So year 0 minus 16,000. That represents the initial cash outflow. And then we start adding the net cash flows in. Year 1, we net cash flow 3,000. So what that means is my cumulative net cash flow is minus 13. Remember, looking for the payback period. So 16,000 plus negative 16,000 plus 3,000 is minus 13. Year 2, net cash flow 4,000. So I take my minus 13 from year 1 and I add in positive 4,000 to get a new cumulative net cash flow minus 9,000. In year 3, my net cash flow was again 4,000. So I take my minus 9 from year 2 and add plus 4 for year 3 to get a new cumulative cash flow for year 4 minus 5,000. In year 4, I again have net cash flow of 4,000. So minus 5 plus 4 is minus 1,000. And then in year 5, my net cash flow was 5,000. So I take my minus 1 plus 5 gives me positive 4,000 net cash flow. I can stop there. The reason why I stopped there is I broke even. Okay, I'm now positive. Now the question is, where did I break even? Obviously, it's between years 4 and 5, but where specifically did I break even? Now, here's how we can figure this out. We take the difference, okay, between the net cash flow and the cumulative net cash flow. Difference between 5,000 and 4,000 is 1. So 1,000 plus the 4 years it took me to get to this point, divided by 5,000, which is the net cash flow it took me to get to this point within the 5 years, gives me 4.2 years. Another way of doing this is, instead of doing it by years, you can do it by months. Okay, if you do it by months, it'll give you the exact point in time. That's how we got 4.2. We know it happened in year 4, and it happened before the end of year 5. So where in year 5 did it happen? It happened in February. How do we know that? Well, if you look at it from a monthly perspective, at the end in December year 4, I had minus 1,000. So if my net cash flows was 5,000, I could take that, divide that by the 12 months, and then add it back in to get to February, which is 4.2. So that's how you see how we got there, right? That's the way to find the exact uh, payback period with uneven cash flow. Now, why don't we use payback period to evaluate um, an investment in the property, plant, and equipment? Well, one of the reasons is because we use cash flows and not income. Because you know that net income is not the same as net cash flow. Our business doesn't solely operate on cash. I got bills that I paid 30 days later. That's not cash. I got revenue coming in from my customers on account, which means they purchased it using accounts receivable. So that's not the same as cash. The timing is not the same. So we use cash flows instead of net income. And the other reason why we use it is because it's easy to calculate. It's very easy to calculate the payback period. A couple of reasons why not to use it, or why some businesses don't use payback period in the evaluation decision, is that it doesn't have the respect of timing of the cash flows, because some companies or some customers will purchase using credit, which means they're purchasing on accounts receivable, and also doesn't take into consideration the time of when bills are paid, right? So it's sometimes unpredictable. It also ignores all the cash flows after the payback period. What I mean by that is, in the earlier example, our payback period was 4.2 years. I don't care about what happened in year 5 or 6 or 7 or 8. I only care about the point where I hit my break even, my payback period. So we ignore the future cash flows after it's fully recovered. And the third reason why some companies might decide not to use the payback period method is because it ignores the time value of money. As we talked about a few weeks ago, time value of money takes into consideration the concept of interest. You know, we earn interest on money, right? So it ignores that fact. So there's just a couple of reasons why some companies will either use or not use the payback period. Okay. Any questions on payback period before we jump into the accounting and internal rate of return? Good so far, right? Excellent. Okay, let's talk about rate of return. The rate of return, a couple of things about rate of return that I want to talk about. As you know from earlier discussions, a rate of return is usually expressed as how much will the investor receive over time based off of a certain percentage over an annual investment. In other words, as an investor, I have a certain rate of return. Okay, I might say, hey, I'll invest in this, but I want 20% return every year. I want 20% of my investment back every year. And then some, right? Interest. That's my rate of return, my internal rate of return, 20%. Companies typically will prefer a higher rate of return when they're making the investment. So going back to our piece of machinery example, When a company decides to invest in a piece of machinery, they want to ensure that their investment will be worthwhile. And they look at their internal rate of return, also known as the accounting rate of return, to decide if that investment will be worth it or not. It helps. The reason why companies use the accounting rate of return is to understand the risk that's involved in the investment. So here are the formulas that we utilize. So the accounting rate of return, we take the annual after-tax net income at the end of, that's on the bottom of your income statement, divided by annual average investments. Now, annual average investments, think of the word average, divide by 2, right? Beginning balance plus ending balance divided by 2. You see book value. You know that book value is what your assets, your long-term assets, are worth, right? Book value. What they're worth on your balance sheet. Beginning book value is at the beginning of the year. What is the current value, book value, market value of your assets, your long-term assets, your property, plant, and equipment? So beginning book value plus end of the year ending book value of your property, plant, and equipment divided by 2. Okay? That gives you annual average investment. Another way to figure out annual average investment, which is more complex, by the way, is the sum of the individual year's average book value divided by the number of years of the planned investment. Let me break this down. The sum of the individual year's average book value is kind of like saying over this number of years, how much are my property, plant, and equipment worth on an average basis based on book value, divided by the number of years I plan on investing into this new piece of machinery. So it's relative, right? You can use either method for calculating annual average investment. I prefer straight line because it's easier, and it doesn't take into consideration years planned for the investment. So I personally prefer straight line method, but you can use either calculation. So this helps the company to really evaluate the risk with the investment and to understand what its internal rate of return is, or also known as the accounting rate of return, because we're looking at it from a company perspective. So let's take a look at our earlier example with a piece of machinery. So we expect to purchase the piece of machinery at $16,000. So beginning of its useful life, $16,000 plus the end of its useful life, which is going to be 0. The reason why 0, end of useful life. As you know, with useful life, at the end of its useful life, it's usually worth 0. That's also its, scrap value, or the salvage value. So beginning book value, $16,000. End book value, 0. It's going to be worth 0 end of useful life. So 16,000 divided by 2 is going to give us our annual average investment. So 8,000, yeah? To find the accounting rate of return, I take the annual after-tax net income, in our example, 2,100, divided by 8,000, the average investment. So 2,100 divided by the 8,000, my accounting rate of return, internal rate of return, 26.25%. That's pretty high. And so, as we had said earlier, the higher the rate of return, the more likely the company is to make the investment. It's good, it's a good method, but sometimes companies might not use the accounting rate of return because it ignores the time value of money, which expressed interest. It focuses on net income rather than cash flows. And if the income is going to be different from year to year, which it usually is, the project might seem more desirable in some years and not in others. In other words, if I purchase a piece of machinery and I know that I'm going to have good years and bad years, it might look really great up front because I know I'm going to have a good year in the year that I purchased it, but in later years it might not be the case. So, and that's relatively subjective, but it's important to understand that these are the weaknesses using the accounting rate of return as a method for evaluating investment decisions. Now, probably the most used method in evaluating investment decisions is the net present value method. Net present value. We use net present value in accounting and in finance to understand the value of money in the future. It sounds easy, right? So, understanding the value of money in the future involves the idea that there is interest earned over time. There's an old saying that says a value of $1 today is not the same as a value of the dollar tomorrow. Well, sure, that's right. And the reason why that's right is if I take $1 today and I invest that dollar, and a year from now, that dollar will probably be $1.08. Why? Because I took that dollar and I invested it somewhere into your bank account, into the stock market, whatever. Over the course of a year, that dollar earned interest. So its value grew over time. It's what I call net present value. This formula helps us to identify how much money I need to invest today in order to have a certain amount in the future. That's the concept of net present value. You can use this formula in a couple of different ways. Okay. One way you can use this in your personal lives is figuring out when you want to retire. Okay, when you retire, you probably need to have a certain amount of income, right? That's the idea. You got to live on something. So we use net present value calculations all the time when it comes to figuring out how much money I need to set aside today in order to generate a certain amount of income when I retire. Okay? That's a great case use for net present value. How much money I need to invest today in order to yield a certain amount when I retire in the future. It's a great method. So that's why net present value is so important. There's a lot of uses for this. To calculate net present value, number one, I recommend a calculator. Okay, I recommend a calculator. I also recommend using Excel. Excel has the formula built in. The calculators, they have the formula built in also. The financial calculators. So net present value is best used doing Excel or a calculator. Doing it out by hand, I don't recommend because it gets very complex. Because there's a lot of different variables, right? You got things like interest, number of years, number of payments, etc. It gets complex. So use a financial calculator or use Excel to find net present value in real life. Yeah. So how we calculate? We take the discount of the future of the net cash flows from the investment at the required rate of return. It's a lot. There's a lot of variables to break down there. So the required rate of return, 26.25%, I think we said it was in our earlier example. We also have the future net cash flows. What did we say? $4,100, I think it was. And then we subtract, step two, the initial amount invested, $16,000 for the machinery, from the sum of the discounted cash flows. Very complex, I know. So required rate of return, also known as the hurdle rate. There's a lot of different names for this. It's how much it cost us in terms of capital to purchase the piece of machinery. Let me explain this to you. And I've said this before, I'm sure I have. Companies raise capital in two ways. Debt, taking out a loan, and equity, raising money through investors. Debt and equity. Taking out a loan, equity, raising through investors. Debt is simple. You go to the bank, take out a loan. There's an interest rate attached to that loan. Very straightforward. That's debt. Equity, the company issues shares of stock, common shares of stock at a certain price. The investors acquire the common shares of stock and they receive a return on their investment. Kind of like an interest rate. That's the required return. So those two must equal 100%. You have debt and equity. Those are your two methods of financing. Okay? And so we find required return, which is also known as hurdle rate. So looking at our earlier example, this chart down here, very common. This is kind of like a way to find the net present value using a chart. Okay. In other words, the chart gives you these present values based off of the chart rather than calculating them. You can calculate them. I recommend Excel to do that. But here's how it works. Company purchases the piece of machinery, $16,000. 8-year useful life, salvage value of 0. Our net cash flow is $4,100. Okay. We require 12% rate of return. That's my internal rate of return. Okay, so at 12%, I can get this is called an index. Okay, it's called an index. I can see based off of this index my yield at the end of the 8 years. Now, in 8 years, my net cash flows is $4,100 a year. 4,100 times the 8 years is $32,800 of total net cash flow. I take the net cash flow for each year and I multiply that by the present value of 1 at 12%. So 4,100 times 0.8929 for the first year, for example, equals the 3,661, also known as like 89%, yeah? You do that for each year using the value index. At the end of the 8 years, we add up our present value of net cash flows for the 8 years. In this example, 20,367. I take my net present value of cash flows, 20,367, minus the initial investment, 16,000, equals the net present value of $4,367. We see that the net present value is greater than the net cash flows for each year. That's usually a great sign. That means that the investment's probably worth it. When your net present value is greater than 0, it's absolutely worth it. Because you don't want just 0. That's 0 is break even, yeah? You want more than break even. You want to ensure that the machine that you're looking to purchase will yield you enough in net cash flows at the end of its useful life. So the decision tree is very straightforward. Present value net cash flows minus the acquisition amount, invested amount, equals the net present value. If the net present value is greater than 0, we do the investment. We'll purchase the machine. If it's not, then we do not purchase the machine. Net present value of an annuity. Let me show you an annuity. Net present value can be used in a lot of different ways. Of course, we use it in investment decisions, but we also use it in decisions about how much we need to retire with. Yeah? This is what's called net present value for a simple annuity. An annuity, as you know, is an equal payment every year for a certain number of years. Annuity. It's a payment that's the same every year for a certain amount of time. That's called an annuity. Examples of annuities would be things like your mortgage. A mortgage is the same amount every month. That's called an annuity payment. That's an annuity that you pay. You might also receive an annuity. If you receive Social Security, for example, that's a form of an annuity. It's the same amount every month you receive it. When you retire, you might have a retirement plan and you receive the same amount every month. So that's a form of an annuity. That's what annuity means. It's the same amount every period. We can figure out the net present value using an annuity computation. In other words, I can sequence the annuities until it reaches 0 by understanding the net cash flows for each year over its useful life and the initial investment at year 0. So initial investment at year 0 is minus 16,000. That's the cash outflow year 0. And I go plus 4,100, plus 4,100, plus 4,100, all the way until the end of year 8. In doing so, plus 4,100 times the present value of 1 at 12% found on the index table, which is 4.9676 times the 4100, gives me present value net cash flow of 20,367. So I take the initial investment minus the 20,367 to get me net present value of $4,367. The net present value is greater than 0, so we would probably make this investment. Here's another example looking at a larger investment, but it's really the same for all intents and purposes. So this one is for what's called a CNC machine. It's a very common piece of machinery used in manufacturing. The company is making this investment in this piece of machinery, that they're evaluating the investment. So they look at things like the present value of net cash flows for the 8 years, which is the useful life, minus the initial investment to get a net present value. Net present value is greater than 0. Of course, we'll make the investment. And we can look at a similar type of investment of using uneven cash flows, using the index table. Now, here are 3 different options: machine A, machine B, or machine C. We can see that the cash flows are not even. We can also see how the net present value is factored. So, for example, for machine A, net present value cash flows is 12,435. For machine B, they would be 12,908. For machine C, 11,803. Machines A or B would be accepted. Machine B has the highest of the net present value out of the 3 options, so I would select machine B. Machine C I would not even consider because it has a negative net present value. Remember, the present value needs to be greater than 0 for it to be considered. We always take the highest option for net present value. Another way to compare options is through what's called a profitability index. We take the present value of net cash flows divided by the investment amount to get the profitability index. This is another way of ranking 3 options, or 3 projects, if you will. The higher the profitability index, the better. So in this example, I would select option 2 because it has a profitability index of 1.5. I would not even consider option 3 because it's below 1. Option 1 would be a second best. Yeah, less than 1, it's a no. It's a no-go. It's got to be greater than 1 for if you're using indexes. As you know, using cash flow can be very risky in business in a general sense. So a lot of firms, before they make an investment decision, they also look at the utilization of their cash. And they might implement a form of what we call capital rationing. It's exactly as it sounds. When I ration cash, I am being very restrictive on how I'm using that cash, right? Rationing, that's what the word rationing means. I am limiting the use of the asset. So hard rationing means that it's I'm imposing external forces and rationing my cash flow based off of those forces. Soft rationing means that management is setting limitations internally for their purposes of limiting cash flow for investment decisions. We're not going to go deep into that. I just want to have you understand. And of course, last but not least, the internal rate of return. Internal rate of return, when the present value of the cash inflows minus the initial investment equals 0, then the net present value must also equal 0. That helps us to also kind of verify the decision. So here's an example. We have a project, useful life is 3 years, the initial cost is $12,000 for the piece of machinery, and we have net cash inflows of $5,000. We take the initial investment divided by the annual net cash flows to get 2.4, which is the net present value factor. To find the annual rate of the internal rate of return, we find the 2.4 on our annuity table. In this case, it is at 12%, so the IRR is approximately 12%. If the internal rate of return is greater than the hurdle rate, and the answer is greater than 0, we do the investment. If not, we do not do it. This slide kind of summarizes the differences between using the payback period or the accounting rate of return or the net present value or the internal rate of return for making decisions in investments. So for those of you who are interested in going into finance and taking finance courses, these are the types of things that you would be focusing on. This is like the very basics of finance. But the reason why we have this in accounting is, again, to help you to connect the relationship between capital investing for purchase or sale of property, plant, and equipment using finance as a basis for making decisions. This is similar. So one last concept I want to show you is the break-even with respect to time. Very similar. We're still using the same methods in the payback period, but this kind of shows you when time is incorporated from a visual perspective of when we break even. So the way to think about this is we have the present value of cash flows that are added from the initial cash outflow. So cash outflow, remember we purchased the machine $16,000. Present value of cash flows $3,727. So we add that into our initial cash outflow, and then we add it again and again, and we see that happen over time. And so we're adding up the cumulative present value of cash flows over time. And this helps us to identify where in time we've broken even. Okay. And we see that when we go from negative to positive cumulative present value of cash flows. And this example, it looks like it happened somewhere in year 5, at the end of year 5, beginning of year 6. And as I had mentioned earlier, you can use Excel to compute present value and the internal rate of return. These are both formulas built into Excel. They're very easy to use, and I highly recommend that you use Excel when doing difficult computations like net present value, or internal rate of return. That, my friends, is the end of our discussion on capital budgeting and investments. Any comments, questions, or concerns on capital budgeting and investments? Very complex topic, I know. Y'all good? Yes, no, maybe? Still awake? Still with me? Yes, hello?
Yes, Professor, right here.
Thank you, Celine. Okay. Thank you, thank you, thank you. Thank you, Giovanni. Okay. Now, the moment you've all been waiting for. Final exam. Okay. We made it to the end of the course. We're now at the final exam. Well, of course, in the Chapter 26 quiz, if you haven't taken it already. They're both due on Saturday. Not Sunday, Saturday. Why Saturday? Saturday's the last day of the term. Okay, so the 13th, this coming Saturday. So, complete your Chapter 26 quiz and complete the final exam. Do the Chapter 26 quiz before you do the final. Why? Because you're going to see similar stuff. Okay. Let me show you the final exam. Let's walk through it together, shall we? Okay, the final. Very similar to the way that the midterm exam was built. There are 20 questions on the final exam. The final exam is 20 questions, which also means it's worth 20% of your total grade. Don't skip any questions, okay? Make sure you answer each question. Take your time. In fact, I recommend you start it now. And remember, you can take as much time as you need. There's no timer, okay? There's no time. Make sure you click Save and Close once if you're not ready to submit it yet. Save and close, save and close. When you're ready to submit it, then you click on Submit. Now let's take a look at the questions. The first question. Well, this is a budgeting question. Okay, so let me back out just for a second because I want to show you where we are in the classroom. Now, as you know, you had your midterm exam back in week 3. So 3 weeks ago, you had your midterm. The midterm covered chapters 17, 18, 19, 20, and 21. What do you think that means? The final exam covers chapters 22, 23, 24, 25, and 26. So remember that, 22, 23, 24, 25, and 26. That's 5 chapters. Chapter 22, 23, 24, 25, 26. That's 5 chapters. If it's 20 questions, okay, it's 20 questions, and there's 5 chapters that it covers. That means there are about 4 questions per chapter. Okay, 4 questions per chapter on the final exam. So looking at the final exam, 4 questions per chapter. Question 1 has to do with budgeting. How do I know it says budget? Okay. Well, guess what chapter that's from? 22, the budgeting chapter. Question 2, all the following budgets is not completed before a cash budget is prepared. Which of the following budgets is not completed? Read the question very carefully, okay? Which of the following budgets is not completed before a cash budget is prepared? You have to know the order in which budgeting is completed. Now, if you remember the PowerPoint presentation for Chapter 22, we very clearly outlined what happens before we get to the cash budget. Remember, we start with the sales budget, and then we generate the production budget, or merchandise budget in this case. And then we prepare the general administrative expenses budget. And then we prepare the capital expenditures budget. Oh, wait a second. Do we? I'm going to have to look at that slide again, I think. Question 2 comes from chapter 22, and I strongly recommend you look at that slide on the various budgets and where they all fall in line. Just a little hint there. Question 3. It's a budget question about the production budget. Production budget always shows. Production budgets always show both budgeted units of product and total cost. I don't think so. But that you'll find that in chapter 22. Question 4. Which department is responsible for the direct materials price variance? Sounds like a chapter on variances, if I'm not mistaken. Now, was that part of budgeting? I don't remember. Oh, I think it was. No, it wasn't. So this probably would have been chapter 23, if I'm not mistaken. Yeah, I think it was part of 23. Question 4 is probably going to be found in chapter 23. Talking about price variances. Question 5. Standard costs are used in the calculation of, well, I'm sure it's some kind of variance. Chapter 23. Question 6. A direct labor cost variance. Question 6, chapter 23. Question 7. Standard costs. Chapter 23. Okay, question 8. Question 8 says, a unit of a business that generates revenues and incurs costs is called a, man, you guys better get this right. What is it? 24? I think it might be 24, maybe. Might still be 23. It's either 23 or 24. Wherever responsibility accounting is. I can't remember which one that was. It was either 20. Do you all remember? Responsibility accounting. What chapter was that? Was that 23 or 24? Who knows? You all know? Kind of, sort of. I don't remember what chapter that was. I want to say it was 24, but I could be wrong. It might have been 23. I think it was either 23 or 24. Question 9. An accounting system that's set up to control costs and evaluate managers' performance. Remember that chapter on performance measurement? That's where you'll find question 9. I know you guys know the answer to that one. It should be pretty easy for you. Question 10. Profit center managers. Oh man, I hope you guys get that right. Yes, you'll find that in that same chapter. It's either 23 or 24. Question 11. Departmental contribution to overhead. Department contribution. Oh yeah, department contribution. I'm starting to remember that one now. Let me think about that one. That must have been Probably chapter 24. That sounds like 24. It might have been 25. I think it was 24 though. The potential benefits lost by taking a specific action when two or more alternative choices are available. It's known as, oh man, didn't we just talk about that last week? I think we did. Thinking all the weeks run the same, so maybe it was the week before. That's either 24 or 25, right? Question 13. Determine a product sales price based on the total cost method. That's definitely 24 or 25. Question 14. Opportunity costs are the additional or incremental revenues generated by selecting a certain course of action. That's definitely sounds like 25. Question 15. Costs already incurred in manufacturing the units of a product that do not meet quality standards are relevant costs in the scrap or rework decision. Yeah, we definitely talked about that last week, so that's 25. I know we talked about that one a couple times, didn't we? So that's 25. So I would safely say that questions, let's see here, 12, 13, 14, and 15 come from chapter 25. So 12, 13, 14, and 15 come from chapter 25. Questions 16, 17, 18, 19, and 20 come from the chapter we just talked about, chapter 26. 26, right? Yeah, 26. So 16, 16, 17, 18, 19, and 20 come from chapter 26. You'll quickly know where it comes from by simply reading the question. My recommendation for success on this final exam are the following. Number one, start it early, take your time. Start it early and take your time. Okay? Read each question very carefully, read each option very carefully. Take a look at the PowerPoint presentations from those chapters. There's a good chance you'll find the answer there. If you don't, it's definitely somewhere in the textbook, right? Take a look at your previous quizzes and homework assignments from chapters 22, 23, 24, 25, and 26. Because some of those questions will be pretty darn similar. Hint, hint. So take your time, start early, read each question carefully, review the PowerPoint presentations from 22, 23, 24, 25, 26. Also review your homework assignments and quizzes from those chapters. Just think carefully. I promise you'll be all right. Now, you'll also notice, hey, there's no numbers in any of these questions. Not a darn one. Most of them are not formula-based. They are definitions. So just think about that as you're going through the questions. Remember, this needs to be submitted by Saturday night, not Sunday, Saturday night. So please start it now. It's got to be done by Saturday night. Start your quiz from chapter 26 now. It's due Saturday night. Do the quiz before you do the final exam, please. because you'll see some similarities. Are there any comments, questions, or concerns about the final exam? We're good? Final exam, you're okay? You got this, right? All right. It has been an absolute pleasure being your professor for this course. I've personally enjoyed the past 6 weeks with all of you. I know that some of you are graduating. Some are graduating this term, but also many of you are graduating in the fall after the fall semester is done. So I will probably see you at graduation. I want you to say hi to me when you see me. Hopefully you attend it. I want you to attend it. I don't know if they'll have one in December. That sometimes they do, but I know for sure they'll have the one in May. So I'll definitely see you there if I don't see you earlier. Stay in touch with me, please. You can always reach me on LinkedIn. For those of you who have a LinkedIn account, if you don't have one, I always recommend that you get one. So if you go to LinkedIn, I will show you. So this is me, okay? So here is my LinkedIn in the chat. I have it in the chat for you. Please stay in touch with me there. Also, you have my email address. You're more than welcome to reach out to me even after this class is ended. If you feel like I can help you in some way in your life, please reach out to me. Okay? You have questions about business, you have questions about personal investing, whatever. Okay? Reach out. I look at myself as a mentor, even beyond just the classroom. So with all of that, I thank all of you for a wonderful class together. Please take the survey. I don't know, did you all get a survey for this course already or no? I know they emailed it to you all, right? If you didn't get the survey, or if you got the survey, fill it out, okay? Please, it helps me, and it helps the university. So please make sure you complete that survey. Is there anything else? Anything at all? This is it. This is it, everyone. You all good? Okay. Well, thank you again for a wonderful semester together. Appreciate all of you. I wish you all the absolute best in life. I know that you'll all do well. Now, do your absolute best that you can on this Chapter 26 quiz and the final exam. Make sure it's done by Saturday night. Not Sunday, but Saturday. So please start it now. Yes? Thank you all again so much for your time. Appreciate all of you. Wish you all the best. And as always, I want you to stay safe, wash your hands, do the right things. And I'll see you in the future, probably at graduation. Thank you all so much for your time.
Thank you, Professor Brandon. Thank you so much. You're always the best. Thank you.
It's my pleasure. Thank you, Celine. Thank you all so much.